Breaking the Mould, our regular look at the financial markets with investment director Russ Mould. Russ, how are you?
I'm very well, Claire, and more importantly, how are you? Because I was off colour last time. I gather you've been not quite yourself recently.
Yeah, I don't know what's going on here, but I am feeling much better
good.
now.
I'm delighted to hear it.
That's my fuss done and dealt with. But
Yes.
Russ, what's your fuss?
Okay, well, there's lots coming up in the week ahead on both the corporate and the macroeconomic front, but I reckon the real fuss is going to be caused by supermarkets and jobs, because we've got full year results from Sainsburys, a first quarter trading update from Morrisons, and on the macro side, don't get clever with me, the non-farm payrolls figure from the United States of America. I promise it's going to be really interesting.
Right, let's get going by tucking into the big grocery chains and start with Sainsburys and Morrisons, maybe?
Okay, let's do it in that order, and it makes sense because Sainsbury's figures come out first on Wednesday, the 6th of May. Now, as the chart behind us shows, the shares have rallied very nicely from their lows, thank you ever so much. And that dash to the checkout's largely been inspired by the launch of Chief Executive Mike Coop's strategic review last November. But begun to run a little bit out of steam now, and that may be due to March's fourth quarter statement, which frankly wasn't any particular great shakes. Now, Coop flagged a 0.3% drop in total retail sales for Q4, equivalent to a 1.9% drop on a like-for-like basis. Now, volumes were up, but that's kind of where the good news stopped, because Sainsbury's has been cutting prices as part of its £150 million price investment plan that's designed to cut out one-off promotions and offer what management would argue is better everyday value on a sustainable basis. Now, so we know the top line, we know the sales figure, so there are going to be four things that we're looking at beneath that when the actual figures come out. The first, the headline pre-tax profit figure, £611 million is the consensus number. The second is the dividend, where there's likely to be a cut to around 7.5 pence for the final, giving a 12.5p figure for the full year. That's because the company's fixing a dividend cover at 2 times earnings. Now, that's still enough for a yield of 4.7% at today's share price, but note that further cuts are expected by analysts for fiscal 2016, given they're expecting a 10% drop in pre-tax profits, and there is that profit to dividend link. Thirdly, we're looking for an update on plans to cut costs and cut capex. And finally, any comments on store closures, refurbishments and values. Tesco's has just taken a big write-down on its property, and Sainsbury's wrote off 628 million quid on its real estate last November.
Now, this is just a guess, but I'm thinking that we could be looking for similar themes with Morrisons.
Elementary, my dear Clara, yes, very good. And also very much like Sainsbury, the stock's actually rallied quite hard from its lows, then paused for breath. Now, David Potts is now on board, new boss. He'll be looking to get costs down, get debt down, oversee development on a new IT platform, and build some trading momentum. So it's all eyes on the Q1 update on the 7th, but this is, because it's just a Q1 update, a lot less detailed than Sainsbury's. The headline's going to be the like-for-like sales number, the top line. Now, in January 2014, or fiscal 2014, like-for-likes excluding fuel fell 2.8%, and in the year that's just finished, the slide was 5.9%. So Potts is going to be looking to show improvement here. That's what he'll be hoping to do, as Morrison did begin to look better as the year went on. If you see from the chart behind us, this shows the like-for-likes for each quarter last year, and at the end, there was some welcome improvement.
So that just leaves us with the latest batch of American job indicators.
First Friday of the month, unless it's the first of the month, in which case it skips, means non-farm payroll numbers, and this is going to be a particularly important reading. The recent US data has been spotty. The Q1 GDP number, which I know we'd traded before, and for once we were right, it wasn't very good, at 0.2%. February's weather's got the blame. That was foul, but it's been okay in March and April, so that excuse isn't going to wash anymore. Now, the March non-farm payrolls number of 126,000 new jobs added was the lowest since January 2014, as the chart of the last 2 years' figure shows behind us. Now, a decent number will be needed to persuade the markets the US is still on track, although a bad number, again, could suggest the Federal Reserve will delay planned interest rate increases, the sort of thing that the market generally is quite happy to see, because again, cheap money has to find a home somewhere, and it tends to head for stocks looking for income and potential capital gains.
Okay, thank you, Russ.
Pleasure.
Thank you for joining us, and we'll see you next time. Goodbye.